Imagine two drivers pulling out of a dealership. They bought the exact same make, the exact same model, but every single month, one of these drivers is writing a check for $400, while the driver right next to them is paying $700. There is no difference in the leather seats or the engine. The only difference causing that massive price gap is a 3-digit number attached to their names. This horizontal spectrum represents the credit score. It is a calculated metric between 300 and 850 that banks and lenders use to answer a single question: exactly how risky is it to lend you money? Looking at the lower end of this scale, the financial reality is harsh. If your number sits below 640, you are in the poor zone. Banks will either reject your application entirely, or they will approve you with brutal interest rates. Even in the 640 to 700 range, considered fair, you are getting approved, but you are still paying a premium. When you add up the extra interest on loans, cars, and daily expenses, a bad credit score functions like a massive, invisible tax on your everyday life. That tax scales up when you move away from cars and start looking at lifetime purchases, like a home mortgage. To see the scale of this penalty, look at these two identical houses. They have the same purchase price and the exact same loan term. But if the buyer on the left has a 650 credit score and the buyer on the right has a 730 score, the buyer on the left pays an additional $130,000 in interest over the life of the loan. This penalty extends to mandatory expenses too. Drivers with poor credit pay up to 115% more for auto insurance than those with excellent credit. That is thousands of dollars extracted from your bank account every single year. This 3-digit number can feel entirely arbitrary, but the reality is your score is generated by a predictable mechanical algorithm. To stop paying this invisible tax, you need to master the specific variables that dictate the calculation. The entire algorithm calculating your creditworthiness is built on exactly 5 measurable variables, and they do not hold equal weight. Let's break down the components of your score. The largest slice is payment history, making up 35% of the total algorithm. The system is incredibly sensitive here. Missing a payment by just a few days can trigger an immediate 60 to 110-point drop in your score overnight. Right behind it is credit utilization at 30%. This measures how much of your available credit you are actively using. If you have a credit card with a $5,000 limit and you carry a $2,500 balance, your utilization ratio is 50%. In the eyes of the algorithm, that means you are relying too heavily on borrowed money. The final 3 slices make up the long-term factors. You have length of credit history at 15%, your credit mix, meaning the different types of loans you hold, at 10%, and new credit inquiries, taking the final 10%. When you look at the math, the strategy becomes obvious. By controlling just those first 2 heavyweight factors, payment history and utilization, you control 65% of the total algorithm. Yet people who are otherwise responsible often stay stuck with bad scores. This usually happens because of a few common oversights. One oversight is paying only the minimum balance. Doing this keeps you in debt longer, but mechanically, it keeps your utilization ratio permanently high, suppressing your score month after month. A second error involves closing an old, unused credit card because you finally paid it off. Notice what happens on this balance scale when you close that old account. The system immediately slashes your total available credit limit. At the same time, it erases the age of that account. With less total credit available to your name, your overall utilization percentage spikes into the red. Typical consumer instincts, like cleaning up your wallet and closing unused accounts, sabotage the algorithm and trigger severe, unforced score drops. Moving a score from a 500 to a 750 requires a specific 12-month operational timeline. Looking at this timeline, months 1 through 3, set up autopay on all accounts to secure that 35% payment history chunk, building a streak of perfect payments. Months 2 through 4, attack utilization. Pay down balances below 30% usage, ideally under 10%. This utilization adjustment is the fastest tactical move you can make. The algorithm recalculates this factor constantly, meaning you can see a significant score boost within 30 days of your very next billing cycle. These initial 4 months effectively stop the bleeding. You have appeased the 2 heaviest factors in the algorithm, triggering its fastest recovery protocols. Month 5 begins the passive building phase. You let your old accounts age without closing them, allowing that 15% credit history factor to accumulate points over time. By month 6, if you have a thin credit file, you can introduce a credit builder loan or a secured card. This adds a brand new positive account to your report, feeding the algorithm more data without requiring you to take on dangerous debt. At month 12, execute the final audit. Statistics show 1 in 5 credit reports contains a flat-out error. Find a mistake and dispute it. Getting it removed causes a mechanical score jump of 20 to 100 points. Once you cross that 750 threshold, the math works in your favor. A car loan drops from 15% to under 5%. The lowest mortgage rates on the market become available, saving you over $100,000. The invisible tax disappears. A credit score is merely a temporary reflection of your habits. When those habits change, the algorithm rewards you. If this roadmap helped you rethink your finances, hit subscribe to keep mastering the systems that control your money.